If I had to pick one, which is tough to do, it'd probably be what's the real yield on US 10-year treasuries going to be. We've had many years of central banks and non-market-based forces setting the 10-year bond yield, which is ultimately many investors' discount rate. As we move away from governments setting or central banks setting the price of long-term government debt, we're in a phase of discovery as to what that yield needs to be or should be for bonds in the USA. And I think where that comes out will have a major impact on pretty much all asset classes and financial markets around the world, moving away from a forced discount rate to one set by the market. And I think the market is currently wrestling with where that natural interest rate should be. There aren't quite the signs of risk that we saw in 2007 compared to now. I mean, there was one of the key issues in 2007 was there were some allocations of capital and business decisions being made around the world that simply just did not make sense. Which is often the sign of some huge misallocation of capital, and that really is what ushered in the crisis. We're not quite seeing those sort of completely illogical pieces of capital allocation that we saw back in 2007, things like loans on houses in excess of the value of the house and things like that. So we're not seeing as many warning signs in the current market as we saw back then.